Remember, as a child, you was advised by your baby boomer parents that if you go to school, get good grades, go to college, graduate, and secure a good job, you will be okay in America. Now just think of two people growing up in America today. One begins their career with flexibility, able to move cities for better opportunities, experiment with different career paths, or aggressively save for future goals. The other begins adulthood carrying a monthly obligation that will quietly shape nearly every financial decision they make. The difference is not necessarily talent, discipline, or work ethic. Increasingly, it is debt. Student loans are often presented as an investment in future earning potential, and in many cases, education does create opportunities that might otherwise remain inaccessible. Yet the way modern student debt functions has transformed what was once described as a stepping stone into something that frequently behaves more like a long-term constraint. The trap is not simply the existence of debt itself. The trap lies in the interaction between psychology, mathematics, and the economic systems surrounding repayment. For many students, the decision to borrow occurs before they have meaningful experience with money. At 18 years old, individuals are asked to estimate future income, evaluate interest rates, understand repayment structures, and predict labor market conditions years in advance. These are calculations that even seasoned professionals struggle to make accurately. The emotional promise attached to higher education often overwhelms the practical reality of borrowing. The focus naturally centers on acceptance letters, campus life, and future aspirations, while the future monthly payment remains abstract and distant. This distance creates a psychological phenomenon known as present bias. Human beings consistently prioritize immediate rewards over future costs, especially when those costs feel uncertain or far away. The opportunity to attend a desired university is tangible and immediate. The repayment burden exists somewhere beyond graduation, hidden behind years of coursework and optimistic assumptions about future success. By the time the bills arrive, the commitment has already been made. Then mathematics enters the picture. A loan balance is rarely static. Interest transforms borrowing into a moving target, meaning that the amount originally borrowed can evolve into a significantly larger obligation over time depending on repayment choices and life circumstances. Monthly minimum payments can create the comforting sensation of progress, while the underlying balance declines far more slowly than expected. For some borrowers, periods of deferment, forbearance, or income disruption allow interest to continue accumulating in the background, extending repayment timelines far beyond the original expectations formed during college. The impact of these payments extends beyond spreadsheets. Behavioral economists often describe money as attention. Every recurring financial obligation occupies cognitive space. A substantial student loan payment influences where people live, what jobs they accept, whether they pursue entrepreneurship, and when they feel comfortable starting families or purchasing homes. The debt effectively narrows the range of perceived options available during adulthood. This narrowing effect helps explain why student debt frequently feels heavier than other forms of borrowing. A mortgage is typically associated with acquiring an appreciating asset and establishing stability. A car loan provides access to transportation that serves immediate daily needs. Student loans, however, finance an intangible asset whose value depends heavily on changing labor markets, institutional quality, field of study, regional economic conditions, and timing. The expected return exists in theory, but the pathway toward realizing that return can vary dramatically from person to person. The deeper lesson extends beyond student loans themselves. Modern economies increasingly rely on individuals making long-term financial commitments under conditions of uncertainty. Whether considering education, housing, healthcare, or retirement planning, people are frequently required to forecast futures that remain inherently unpredictable. Student debt simply represents one of the earliest and most consequential examples of this dynamic. Recognizing the trap does not require fear or cynicism. Instead, it invites awareness. Financial systems shape behavior, often in subtle ways that remain invisible until years later. Understanding how debt influences incentives, restricts flexibility, and interacts with human psychology creates the possibility of making more informed choices. The goal is not to reject education or condemn borrowing universally. Rather, it is to replace automatic assumptions with careful analysis. Ultimately, student loan debt becomes a trap when individuals inherit obligations they do not fully understand, within systems that reward optimism while minimizing discussions of long-term trade-offs. The most important financial decisions are rarely defined by dramatic moments. More often, they emerge from a series of ordinary choices made under social pressure, limited information, and sincere hopes for a better future. Perhaps the most valuable shift in perspective is recognizing that financial freedom is not solely determined by income. It is equally influenced by obligations. Wealth is not simply what flows into a person's life through paychecks and promotions. It is also shaped by what has already been promised away. Understanding this distinction may not eliminate difficult choices, but it can transform the way those choices are approached, replacing assumptions with intention and encouraging a broader conversation about what true opportunity should look like in the modern economy.